So hi, Ben Kingsley here with Simon. We're here to talk about the mortgage outlook for 2016. Simon, would you like to introduce yourself?
Simon Gillespie, one of the senior finance advisors at Empower Wealth, working very closely with Ben. And Ben, we were talking earlier about, some significant changes that have been happening over the previous months, and maybe you'd like to expand on that.
Yeah, sure. I mean, obviously we saw the big change was the APRA intervention into the marketplace. So part of that was twofold. One, we saw them wanting to slow down the investment lending. So we wanted to see, they were basically looking at how much investment lending can happen. And then two, we started to see them say, how are they handling serviceability, didn't we?
Most definitely.
And then finally, what happened was we started to see an out of rate cycle rise by the banks, which was a little bit surprising and maybe a little bit of a margin grab. But the reason I think behind that is the banks obviously need to shore up their capital, and that's probably part of that process. So as we move into 2016, what do you see as some of the trends happening in the mortgage market?
Well, I think that we may continue to see some of those changes in interest rates, whether in cycle, out of cycle.
Yep.
Who knows what you can call it what you like. But I do expect that there are going to be some variable changes, and I think there may, whether it's this year or moving forward, maybe even just a further gap between that cost of owner-occupied debt versus investment debt as we move forward.
So we'll see. So in your view, maybe 10 to 20 basis points?
I'm not going to set a number on it because I don't have that mirror ball, but I suppose it's just an expectation that there have been changes. It's obviously made a difference, but we may continue to see more of that change. So it just comes into my thinking when I look at structuring a loan and long-term planning that these changes could come to fruition.
Yeah, look, I agree. I definitely think that we're going to see, and I'll probably put a number, and I reckon 10 to 20 basis points. And I think, we're almost seeing out in the media right now a bit of a conversation around it. So it's almost like we're getting prepped for this out-of-cycle rate move, and we're just going to have to bear it. It's like all things, the costs always get passed on to the end consumer. So we're going to see that happen. Outside of that, what do you see as some of the other trends in 2016?
Well, I think they're going to be a bit more. I think with these changes, the banks they've made a big shift, and it's had an impact. And we may start to see some movement back around cost of lending. What they're willing to offer to generate business. So whether that's we're still seeing, and I imagine continue to see, cash payments for refinances. We're getting updates on discounted life of loan rates for certain clients. So I think we're going to see a bit more of that moving forward, where banks are trying to get back some of the business that they've lost.
Yeah, I agree. It's like mortgages are going to go on sale. I think there's going to be more of a commodity type arrangement where, because effectively you can refinance a mortgage, can't you? I mean, there's no break costs anymore.
Day after.
Yeah, you can do it the day after. So I think with that type of mentality, I think the banks are going to be, going on sale a little bit more. Moving on to other areas, in terms of fixed rates, do you have any views on fixed rates?
For our clients, I suppose our clients, where we are dealing with long-term investors who are creating wealth through property and planning, and we're going to be taking on significant debt. So fixed rates, they are very well priced at the moment, and we're actually, what I haven't seen, until recently, was actually pricing on fixed rates. So actually reducing the fixed rates.
Okay.
So we're still looking at around the mid-4s for 5 years. And when you're talking long-term planning clients who can lock in that cost for that period of time while the portfolio grows in value, the rent picks up, it's just I see that as a good way to control the cash flow.
And cash flow is king. We're big on that here at Empower Wealth. You know that. I tend to agree. I think that, given that you've got outer rate cycle increases coming through, and it might be more than 20 basis points over the next 12 to 18 months, 24 months, then having that surety around locking a portion of your money into a fixed period is not a bad idea. In terms of strategy and structuring, are we going to make any fundamental changes in 2016 to the way in which we've gone about it in the past?
No real fundamental changes. We're still doing, property self-secured, no cross-securitization. I suppose part of what has happened, there is a bit more fixing involved now.
Yep.
Again, for the reasons as we've just mentioned. Yep. But also, I do, with my view on, let's say, the assessment of what has changed, what may continue to change around investor lending, where it's obviously important. If you can't borrow money, you can't buy a property.
Yep.
So equity is critical. Yep. And I do have the view, if you do have equity and you can access it, I do have the view of park it there for when you need it. So if something changes and you can't get it, well, you're stuck. Once you've got it, you can control it and use it when required.
And that's true. I mean, and we've seen obviously with these changes that borrowing power has been affected. So, you know, we know that our borrowers can't borrow as much as they've been able to in the past because of this tightening of these credit policies. So that is going to be a challenge for 2016. I mean, you know, we might have had clients that expected that they were going to be able to borrow more and they can't. So we need to obviously look at the way in which we put lenders together and bunch them up with one lender or maybe a couple of lenders.
We will see a lot more of that actually, where you may have your prime lender, but as time goes by and things change, you need to look at alternatives where you're able to continue to build that portfolio. So it's not now uncommon to have not even two, but maybe three. Don't see a lot of four, but three may not be uncommon.
Three lenders, that is. So, and that's really important. So nothing really changes in terms of, we're still big believers around, it's almost mortgage planning. I mean, that's exactly what it is. I mean, strategically, we want to get the money for the client so they have the opportunity to invest both obviously in their own home, but also invest into a portfolio of properties so they can build passive income for life.
Correct.
Yeah, and the other thing that I wanted to just mention, interest rates. Do you have any views on where interest rates are going to be throughout the year 2016?
Maybe some variability, but not high one way or the other. So I think it might stay relatively flat for, you know, a good couple of years, with some minor fluctuations in between. But that's a
look, lower for longer.
Guess.
I mean, ultimately, it's probably lower for longer. I suspect that if the banks do these out of cycle rates, it does give the RBA some capacity to maybe drop rates. And we saw in the minutes, not in the minutes, but in the commentary just released in the first board meeting around that they're sort of saying they've put a comment in there, a paragraph in there around, we have the ability to drop rates. So you might see this out of cycle, but they were like, well, wait a minute, that's going to slow down consumer confidence and consumer spending. So we'll drop one in there, which will hopefully offset some of that sort of out of cycle movements that we might see from the banks.
Yeah, definitely.
So there you have it. I mean, there's our wrap. It's obviously a game. It's about getting great advice and planning out, you know, not just the next step, but the step ahead in terms of what you're looking to do. Banks are changing the way in which they operate. It's a bit of a fluid environment. We certainly think that there'll be more banks on sale in 2016. We think that fixing a portion of your loan is prudent in terms of what that looks like, and the strategy and structuring work that we're asking the clients to do through working with, you know, professionals like ourselves is the best way to move forward. Thanks for watching.